Investing can completely change your financial future, but most people never get it right. They choose the wrong investment path, not because they are careless, but because they never truly understand the difference between stocks and bonds. And that mistake can cost thousands over time. In the next few minutes, you'll learn exactly how both work, which one builds wealth faster, which one offers more safety, and how smart investors use both together. First, like the video and subscribe to the channel for more simple investing explanations, and press the bell icon so you don't miss the next video. Now let's start with stocks. A stock represents ownership in a real company. When you buy stock, you become a shareholder, meaning you own a small piece of that business. Even one share gives you ownership rights, and although the percentage may be small, it is still real ownership. If the company grows successfully, you benefit, but if it struggles badly, you suffer too. That is the foundation of stock investing. Think about companies like Apple, Amazon, or Microsoft. Millions of investors own shares in them today. They don't run those businesses, but they still participate in their success, and that's what makes investing interesting. Stocks create wealth mainly in two ways: capital appreciation and dividend income. Imagine investing $1,000 in a company that grows rapidly over time. Sales increase year after year, profits exceed expectations, and more investors want ownership. As demand for shares increases, stock prices rise, making your investment more valuable. If you sell later, the difference becomes your capital gain. That's how many investors build wealth. The second way is dividends. Some companies distribute part of their profits directly to shareholders instead of keeping everything for growth. These payments provide income even while you continue holding the shares, which is why dividend investing is popular. However, not every company pays dividends. Many fast-growing companies reinvest everything back into the business to launch new products, expand into new markets, hire talent, and increase future growth. But stock prices don't move smoothly. They rise and fall every single trading day based on news, earnings, and investor emotions. A strong earnings report can push prices up quickly as investors rush to buy, while weak results can cause panic selling and sharp declines. That's why stocks feel exciting but also stressful. For example, Sarah invests $2,000 in a tech company she believes in. 1 year later, the company launches a successful product, revenue rises, and investors rush in, pushing the stock up 40%. Her investment grows to $2,800, giving her an $800 profit. But the opposite can also happen. If the product fails and revenue disappoints, the stock could fall 30%, leaving her with a significant loss. Same company, same investment, completely different outcomes. That's stock market risk. Now let's move to bonds. A bond is very different. Instead of buying ownership, you are lending money. Think of yourself as the bank. Governments and companies need money for projects and expansion, so they borrow from investors through bonds. When you buy a bond, you lend them money, and in return they promise to pay regular interest and return your principal at maturity. For example, a $1,000 bond paying 5% gives you $50 per year until maturity, when you get your $1,000 back. Bonds often feel safer than stocks, but they are not risk-free. One major factor is interest rates. If new bonds start offering higher returns, your existing bond becomes less attractive, and its market value falls. If new bonds offer lower returns, your bond becomes more valuable. This leads to a key rule: when interest rates rise, bond prices usually fall, and when interest rates fall, bond prices usually rise. Bonds also carry other risks like default risk, where the issuer may fail to pay, inflation risk, where rising prices reduce your purchasing power, and interest rate risk, which affects bond value over time. So while bonds are more stable, they still carry important risks. Now let's compare both directly. Stocks give you ownership, while bonds make you a lender. Stocks offer dividends and capital gains, while bonds provide fixed interest payments. Stocks are more volatile but offer higher long-term returns, while bonds are more stable but generally provide lower returns. Stocks are better for growth, while bonds are better for stability. Neither is perfect, but both serve important roles. Most successful investors don't choose one, they combine both. Stocks help build wealth, while bonds reduce risk and balance volatility. For example, a young investor like Mark may hold 80% stocks and 20% bonds because he has time to recover from losses and focuses on long-term growth. On the other hand, someone like Jane, who is close to retirement, may prefer more bonds and fewer stocks to protect her savings and generate stable income. Different goals require different strategies. Stocks represent ownership in businesses, while bonds represent lending money. Stocks offer higher growth but higher risk, while bonds offer stability but lower returns. Most investors benefit from using both together in the right balance. So take a moment and think about your own portfolio. Would it survive a market crash, and would it still capture future growth? If you learned something valuable today, like the video and subscribe the channel for smarter investing insight.